Okay, not L. Good morning, everybody. Mark Mappa and Steve Wilhusen with Mappa Wealth Management. We're here to talk to you about financial stress relief, ways to reduce the worry about money. My name is Mark Mappa, and on the right is Steve Wilhusen. We have over 45 years of financial planning and wealth management experience. I've been in the business for over 28 years. I hold a number of financial designations and degrees, Masters of Science in Financial Services, Certified Financial Planner, and some other designations. And Steve Wilhusen has 18 plus years financial planning experience with a couple designations, Chartered Financial Consultant and Chartered Life Underwriter.
We provide a myriad of different financial services that you see on the screen here, most commonly being investment planning, but we also talk about insurance, college funding, estate planning, things of that nature. We recently joined the Association of Financial Educators, something we're very proud of. That is an association that goes around to mostly different companies and essentially sets up workshops and private education events for their employees. We're part of the presentations on that, and we're also doing a series of webinars for the American Liver Foundation. It's something that we like to do to both advertise our services and also to educate the public on financial planning, different topics. Our contacts, there's our website, mappawm.com, and then if you have any questions, our phone numbers will be at the end of this presentation, but most people like to email, so it's either Mark at mappawm.com or Steve at mappawm.com.
Okay, so our agenda for today is know your risk tolerance, turn down the noise, diversification, insure against the unknown, and to be conservative. So first, let's talk about know your risk tolerance. Don't just invest when the market's when everything's going up. It's important to define what money is going to be used for. For example, when you're investing, is it towards retirement, towards college that you might need in the next 10 years, or are you looking to buy a car in the next 2 to 3 years? So based on that, you want to divide up your strategy between short-term investments, which is generally anything less than 5 years, and should be more conservative. The last thing you want to do is invest in, high growth stocks when you're going to need the money for a purchase of a car or for college tuition in 2 or 3 years. And just as you're ready to take the money out, the market drops substantially. Long-term investments, anything 10 years or longer, you can reasonably look to be a little bit more aggressive with that money, because if you have volatility or market ups and downs, again, you don't need it short term. You have time for the market to come back and get some overall long-term growth. Allocate your investment base on your time frame and not just on what your gut says to do.
Okay, this is my favorite slide here, and I call it "Turn Down the Noise." So, the title of this presentation is financial stress relief, or ways to reduce some of the stress that goes along with being with or investing money. And when I say turn down the noise, I really just mean turn down the TV or the radio. So we have lots of clients that ask us a myriad of different questions, but a lot of them come from the TV and simply watching CNBC. And I always tell people is just turn the volume down on that. It's really just going to drive you nuts. Most people are not traders. They're not, economists that want to buy and sell different currencies or these little penny stocks and whatnot. Most people invest in the diversified products. So listening to these types of shows that go into detail about a company or a currency that's going crazy right now and everybody's making millions off of it, it's just not practical for the average investor. So I always say just change the channel or turn it off. These things are going to, make you go crazy. And one thing, if you do watch these shows, you have to understand the purpose of whatever that person's talking about is to sell ad space. It's not to give you unbiased financial advice. They might be talking about a company or price to earnings or something else that's going to be going up or down. But the purpose of that show is to sell commercials. So they want to get you to watch the show, and they're going to be dramatic about whatever they're talking about simply because they know that's what makes people tune in. So to me, this is why I say turn down the noise. You don't want to get in front of that and have it drive you crazy. Just turn it off and go watch something a little bit more relevant to yourself.
Right. Absolutely. Nothing further from the truth. Plus, remember, they're literally talking to millions of people. and everyone's situation is different, and there's no way to provide personal advice. Of course, there's no one size fits all. So again, take the information with a grain of salt, realize that, there's other motives and intentions behind it. And, everyone's situation is different. You can have 10 people with, similar ages, same amount of family size, incomes, and objectives and risk tolerance and all those factors all come into play. It can be completely different.
And then lastly, the stock market's not a hobby. A lot of people treat it like a hobby, or some people treat it like it's the roulette table in Las Vegas. To me, this is not something that's supposed to dominate your thoughts or your actions. You shouldn't be waking up every day to check your portfolio, and then checking it at the end of the day, that type of thing. These are long-term investments. They don't need to be poked and prodded every single day. That's usually when people make bad decisions on their money, is when they're constantly looking at it and constantly making changes. It simply needs to be left alone for a little bit, let it do its thing. So let's talk a little bit about another way to reduce some of your stress here, and that's diversification. So when you talk with any professional, they're always going to say, first, you need to diversify your assets. And what does that really mean? And everybody knows what don't put all your eggs in one basket means. It means spread out your stuff, spread out your money. Okay, you don't want to have all your portfolio in one stock or even one index. I've seen people say that, well, I was invested in the S&P 500, and that's 500 stocks. Isn't that a lot? Isn't that diversification? And well, it is a lot of stocks, I guess, if you think about it in terms of comparing it to one or two. But what people don't understand is diversification means you need to buy things that go up and down based on different information. So the S&P 500, it's the 500 biggest companies in the world. Oftentimes they react very similarly to economic news. So from a diversification standpoint, a lot of them are going to go up and down kind of similarly, and that's not diversification. Those are highly correlated assets, which means that they do the same, they go up and down at the same time, they kind of react the same way to different financial information. So when we talk about diversification, you need to have a combination of stocks, you need to have bonds in there, you need to have cash. A nice portfolio is going to be made up of a lot of different types of investments, not just a few stocks and maybe a little bit of cash. It needs to have stocks, it needs to have bonds, it needs to have assets that don't move in the same direction when the markets are going crazy. So if the stock market's down, typically your bonds are holding it back up. If it's going up, yeah, your bonds might not necessarily be making as much money, but that's what they're there for. They're there for when the times where it goes down, to help solidify your account, that type of thing. So Mark's going to talk a little bit about the different types of investments that you can have in a portfolio, the different types of stocks and bonds, things like that. I'll let him touch on that.
Yeah, absolutely. So a couple of the key core asset classes would be growth and value stocks. And growth are typically companies that take their earnings and reinvest it, so the company and then ultimately the share price can grow. Value stocks or companies are typically companies that may be out of favor, undervalued, and maybe there's issues going on in that sector or industry or that company as well, and there's a buying opportunity. The stock price is down, but there's opportunity for it to increase in value. So long term, they've done historically about the same. Value stocks have actually slightly outperformed. They're highly correlated. However, it does make sense to have both in your overall portfolio versus one or the other. Everybody likes to have the growth stocks. That's typically your water cooler, around the water cooler. Hey, what are you buying? Your Apple and your Google and stuff like that. But don't discount the value stocks. They, again, no pun intended, they do add a lot of value to the portfolio. And of course, there's different market capitalization. Large cap like the S&P 500, medium-sized companies, and then small companies as well. And of course, there's different types of bonds to further diversify. You can go into government, treasury bonds or treasury bills, corporate bonds that are issued by companies like, again, an IBM or a Microsoft. And then there's municipal or state bonds as well. And of course, they have what's called different maturities or duration. So for example, maturity would mean a bond is going to mature in 20 years or 30 years. Duration means that you go out in the market and you're buying a bond that was originally issued for 30 years and there's only 5 years left. So your duration of that bond in just 5 years is going to mature. So there's some strategies behind selecting the appropriate bonds and diversifying. And of course, there's real estate. And there was a time when everybody thought real estate went nowhere but up, but real estate can be a volatile asset class, especially in the traded environment where you can buy and sell like a stock or a mutual fund. But again, it's another way to help diversify. And then the asset class called alternatives, that in the past, since about 2008 or after 2008, after the market crashed in the Great Recession, alternatives have become more in favor. And again, the idea behind alternatives is that they're less correlated to the stock market and even the bond market. So you have further diversification. So alternatives could be things like commodities and market indices and different ways to leverage an investment strategy to help lower the volatility and ideally help protect the downside. Of course, there's no guarantees, but that's the intention of including alternatives in the portfolio.
Okay, let's change topics from a portfolio to another way to reduce some of the risk that goes along with handling money, and that's to buy insurance. So insure against the unknown. That's essentially why people buy all the different types of insurance policies. So some of the more common ones: health insurance, life insurance, home, auto, disability, et cetera, et cetera. So, you know, the whole reason that we do these types of things is for the unknown. We don't know when we're going to have a fire in our home, or we're going to get sick, or we're going to die. But buying insurance policies to protect or provide financial assistance if one of those emergencies comes into play is a way to reduce some of the stress. You simply know, you know what, I'm covered. You know, I have health insurance. If I get sick, you know, I'm not going to feel good, but at least I'm going to have it paid for. And that goes across the whole line of insurance policies: home insurance, auto insurance, disability. That's a big one. If I get hurt and I can't work, at least there's an insurance company that's going to pay my bills. And another thing that gets overlooked with insurance policies is how often you review them. So we always recommend that people review their policies once a year, at least annually. So oftentimes that doesn't occur. We get it. You know, insurance is not the most fun topic to talk about, and people oftentimes say, it's fine, nothing's changing. But, you know, you don't want to let it go 3, 4, 5, 6, 7 years before you look at it again. Okay, you're going to have life events that occur during that time period that may need you to alter your insurance plan. You know, a big one is the birth of a child. When you have a kid, you know, it's not about you anymore, it's about the kid. And so you need to make sure if something happens to you, the child is taken care of. That's when people oftentimes will buy something like life insurance. You need to review your disability. It's probably been a few years since you looked at it. You may have gone up in income a little bit. And you know what? I might need a little bit extra coverage, because if I do wind up getting hurt, it's not just me that's on the hook there. I've got a kid. So look at everything. Obviously, the health is going to get reviewed then. And then, you know, another life event would be somebody retires, there's a death in the family, and then another big one is a marriage or a divorce. All of those types of things are times to review your insurance plan, because significant changes have occurred in your life, and you know, you're going to need to alter your insurance plan as a result. There's another topic here that a lot of people don't think of, and that's insuring your money.
Yes, so basically that involves using well, the key is that, you know, providing when you're ready to retire an income stream that you cannot live. And most people look at that and say, well, if I worked for a company, I have a pension, I'll get a monthly income for as long as I live. And then also, of course, Social Security, that they will get a paycheck for as long as they live, and people, you know, embrace that. But a lot of people don't have the option of a pension from a company. They may just have Social Security, which isn't enough. So there are ways to, again, take money from that you've accumulated and saved for retirement and utilize what are called annuity contracts that also can provide guaranteed lifetime income. And the key is to focus on what is the best way for your overall portfolio to take the least amount of risk and maximize the amount of retirement income that you have. The reality of it is the PhDs out in the field that are in economics and math and statistics and finance all promote and suggest incorporating annuity contracts into your portfolio to make sure that you don't outlive your retirement income. As people are retiring earlier and or living longer, then there's what's called a new risk, which is longevity risk, the risk of outliving your your income. So that should be really the focus on in the retirement planning spectrum. And then going back to the insurance, Steve and I are big advocates of saying, when you're looking at your insurances, whether it be life, disability, long-term care insurance, plan as if it's going to happen and hope that it doesn't, which basically means that we don't know what's going to happen. You can be very healthy, young, but statistically nothing's going to happen insurance-wise. However, unfortunately, things do happen to individuals. So if you have the adequate coverage to protect yourself, your family, your loved ones, this way, that's the peace of mind. You could take that concern off the table, and then hopefully you go about your day and your life and never have to worry about it. So that's what we strongly suggest and encourage people to look at that way. Plan as if it's going to happen and hope that it doesn't.
Okay, and then lastly, another way to essentially lessen the stress that comes along with handling money is just be conservative. Okay, it's okay to earn less when when the market is up, as long as you don't lose as much when it's down. And that can be really tough to do when the market's going up quite a bit and everyone's talking about how much money that they're making. But realize what goes up must go down at some point in time. So you have to maintain your diversification and don't let go of those conservative assets just because everything is going up. That's been, we've had a really nice bull market here for the last 9 years or so, and everyone's getting a little bit comfortable with how the stock market goes up every year. But everyone can still remember 2008 and how much was lost during that time period. So it's okay to hold on to your conservative assets, particularly if it's going to make you feel good and sleep at night. So another reason that it's important to continue with those conservative assets is because of something we call the sequence of investment returns. Now, this is actually very important during the distribution stage of life, most commonly known as retirement. That's essentially when you're taking money out. And the reason it's so important to have consistency in your rates of return when you retire is because if it goes down a substantial amount, when you're taking money out, it's harder for it to come back because you took it out when it was down. You don't have as many shares left. When you don't have as many shares, when it goes back up, there's not as much money there to go ahead and recover some of the losses there. So you need to have more consistency when you're in that distribution stage of your life. Because it's simply not going to recover back. Now, let's take a look at a couple of examples of how two different investments that invest in similar portfolios will result in a different dollar amount based on the same rate of return. I'm going to let Mark go through that stuff.
Yeah, absolutely. So if you consider an investment of $100,000 and the first year goes up 20% and then next year goes down 20%, a lot of people will look at and say, well, okay, what's my average rate of return? But if you look at the account value after 2 years is only $96,000. But the assumption is that average return is 0%, right? You're up 20, you're down 20, divide that would be 0. So you'd think you still have $100,000, but that's not the case. You've actually lost money. Now, if you consider a more conservative portfolio, the same $100,000, however, your portfolio goes up only 10% the first year, but then goes down only 10% the following year, your account value is worth $99,000. You're still not back to even. However, the distinction is both portfolios had an average rate of return of 0%. However, the less volatile, the one that didn't maybe make as much, but more importantly didn't go down as much, actually had a better, what it called real rate of return. It lost less and actually you have more money in your account. At the end of the day, that's what matters. Average rate of return is what the industry, the mutual funds like to promote, but it's absolutely very misleading. The bottom line is you want to definitely protect the downside, more important than trying to get your money to grow on the upside.
That's exactly why we talk about consistency and rate of return being more important than the average rate of return. Just, you can't give it back. Okay, when you get it, hold on to it. Hold it like it's your very important baby and don't let it go back. So maintain that diversified portfolio, stay conservative, because in the long run, that's why the tortoise beats the hares, because he just consistently goes and eventually your portfolio will grow. Just don't give it back. It's so much harder to make the money come back than it is just to hold on to it. So in conclusion, money doesn't need to be a source of stress. It is for a lot of people, and we get that. people oftentimes will come into our office and they're stressed as heck about what's going on with their financial situation. But if you take the proper steps and put it together a plan that's based on your goals and specific to you and what you want to have done for yourself, define your goals, stick to your plan, and it's not going to be as stressful. You're going to be able to enjoy the other parts of your life that should be more important to you than worrying about your money. That's what we have about financial stress relief. If you have any questions for us, please go ahead and don't hesitate to contact us. There's either Mark, he's up in the burbs in Glenview, and Steve's downtown. By all means, please reach out to us in either an email or a phone call. Thanks for your time today.
Thank you. Cut.